Hey, this is Nick from Us versus Herd. Today we're going to go over penny stocks and why I believe that you should not trade them. There's a lot of stuff online that promote penny stocks and say you can get rich quick. Some say that it takes a lot of work, but you can get rich. But my theory is that there's a lot of ways to make money in the market and you shouldn't trade them at all. And in terms of corruption and what's going on in the market already, adding penny stocks into the mix, probably not the greatest idea. Right here, what you're looking at on the screen is one of the more popular ones, SUNE. It is now Q. That means that it is a bankrupt company. It is now anything with a Q placed after it means it is bankrupt. So we can go over to where it was kind of in its heyday on SUNE. Still have a Yahoo Finance chart here. And as you can see that the stock used to be trading in the 20s and 30s, and then last, what was it, 2015, a couple summers ago, there was trouble in the company and the debt started to accumulate, and then they just started losing investors, major institutions, and the wind down. And there's a lot of dips here. You could buy and sell if you're day trading it, but in my opinion, it's just not worth the risk. And as you can see here, it stopped trading here last April 2016 at 34 cents and then went bankrupt. And what that means is when a company goes bankrupt like this, any investors here that bought down here at SUNE or who are still holding, doesn't matter when you bought it, who had bought in the 20s and then or bought when it's $1 or 30 cents, when it goes into bankruptcy, you lose your entire investment. So any investment, whether you invested $100, $1,000, $10,000, you lose it. Directly from the SEC here, after a company files for bankruptcy, it is then a Q is added to the ticker symbol. So here we have SUNE, and as you can see up here, it is now SUNEQ. Now, the danger of trading the Qs is, first of all, they're over the counter, meaning they're not traded on the exchange, they're traded over the OTC. So even the SEC here says, in most companies, when a company emerges from bankruptcy, the reorganization plan will cancel the existing equity stocks and old shares will be worthless. So if you're trading SUNEQ right now in the 7 cents today, and we can zoom in here on the last few months to give you a better idea. So right now it's at 7 cents. If you're trading that and you have any investment in there, and then they come out of bankruptcy and they lose the Q and go to SUNE, then you also lose your investment there as well. Now, it moves to the OTC market when a Q is placed or when they file for bankruptcy, and this is a decentralized market. They're basically individuals trading with individuals, and there's no, I guess there's not regulations, there's just fewer regulations. So if you take a look, yeah, you can look at this chart. In September, it's trading for 4 cents, and it rips up to 25 cents, and you made, couple 100% there, and then, but basically, I don't see the upside in doing this. There's a lot of ways with options that you can make this same type of gain and a lot safer. So I'll give you some examples here. Some other popular ones that people like to trade, GBSN, and one of the things that people look at, I think this is a 5-year chart, is saying, oh, this stock was once worth $87,000 and now it's worth a penny. I'm going to invest a ton of money, get in on the ground up, and they have nowhere else to go but up. And that's not true. They can file for bankruptcy and you lose your entire investment. And the reason why the stock is $87,000 on long-term chart is they had so many reverse splits that that their stock is valued at $87,000 doesn't mean their market cap was that much or that they actually ever had any money. It's just that when you get to a certain point in your stock, you can then reverse split. So you could do like a 5-to-1. So let's say you had a dollar stock, you could turn that dollar stock into a $5 stock by reducing the number of shares. So some other ones is Zoma. or XOMA as you pronounce it. And this is another penny stock, and you can see here they did a 1 for 20 split here. Zoom in on this. And probably one of the most famous ones at all is KBIO. Now, KBIO is a pharmaceutical company, as you can see it here, stock traded. They have KBIO and KBIOQ. So as I told you before, KBIOQ means the company filed for bankruptcy, and they are now have a Q placed after them. So KBIO doesn't even load anymore. Oh, I guess it does. Last was trading in, let's see here, they have the Q. Yeah. KBIO, let's see, did they come out of bankruptcy? Not sure they came out of bankruptcy, but looks like there are some trades here. Not sure what that means, but regardless, the KBIQ, June. So KBIO may have come out of bankruptcy, but regardless of that, what I want to show you here is a longer term chart on KBIO on when people started losing. So the other dangers is people short penny stocks, and shorting penny stocks is probably the one of the worst things that you could do because it's undefined risk. And this is just a Google chart, and you can see here on 2015 this was trading for 90 cents, November 2015, and then basically they said they're going to wind down operations, and you're basically shorting a company that is already going bankrupt. So I'm not sure why you would risk losing the money that you placed on the short. Yeah, it could go to zero. So if let's say it's at 90 cents and you short it down to 30 cents, I mean, I guess that's like a 60% gain, or well, quite a bit more than a 60% gain. But what happened here then was that whole Martin Shkreli debacle where he started buying shares, and then it pumped it up to $34.83. So if you're short down here at $1 and it goes to $34, you owe all that money to E-Trade or TD Ameritrade or whoever your broker is at the time. They're going to be coming knocking on your door saying you owe a ton of money based on how many shares you were short, and if you didn't cover in here, which when it skyrockets like this, you don't always get the best price. And as you can see, this was short-lived and it came back down. But basically, if you're short that much, you're going to get you're not going to have time to wait because you're going to get a margin call. E-Trade's going to be calling you up saying you have 24 hours to fulfill this, and if you don't, we're going to close your account, and you're going to still owe us the money. So as you can see here, one of the downside was this guy here that was short KBIO. He owed E-Trade. Try to zoom on this here. I don't know if you can see that. He owed E-Trade $106,000. So he had, previous to close, he had $33,000 in his account. Thought he had more than enough, and then he shorted KBIO, and now he's negative $106,000 in his account before he was able to cover. And he started a GoFundMe page, which, trying to get other people to help you up because you made a mistake is a bit weak, I would say. Now, if you look here, let's see where he gets into some commentary here. So he said that he could definitely lose the $37,000. I can, right here it says, I can afford to lose most of what I have is $37,000, but E-Trade, he owed E-Trade $106,000. Basically what happens, he stepped into a meeting, he shorted KBO, stepped into a meeting, and then the stock blew up. He didn't realize it, came back out, and the stock was at $16 and his account was negative 100K. He said that he figured it was a mistake and E-Trade would never let that happen. They should have closed his account when it got to zero. So that's the other thing. He placed his trust in the broker, thinking that they're going to help you out when most brokers are not looking out for your interests. Let's just be honest. They're looking out to make fees, make money off you. They're definitely not looking out for your interests. So that's why you just, when you're trading stocks, you can't trust anybody. So he said right here, he called E-Trade and the shares the shares got out of hand. The stock price got out of hand too fast for them to cover for me. And he said, all he can do is cover now. And he asked me to cover at 16. And he got filled around 1850 was his average fill. So a couple things that he did here was he thought it was E-Trade's fault for not alerting him that he was negative, 100K. He also thought it was E-Trade's fault that they didn't automatically close his account when he lost the whole 37,000. He said, never in my wildest dreams did I imagine that E-Trade would not have some sort of stop or circuit breaker in place that would automatically cut a position if my account went to zero. However, they let it go to a negative 144K loss on account. Now, like I said before, E-Trade is not looking out for you. They are looking out for themselves, getting fees, and they are definitely not in your interest. When you invest in something, especially if you're shorting a penny stock, you have to know that the risk that implies. So if there's any upside to that, it's gonna get bad. It's gonna get bad quick. Now you can get gains quick, but this is a prime example how you can lose money and lose money that you don't even have. So I would definitely say that this was probably one of the worst case scenarios. There's probably a lot of people out there as well that have lost a lot of money. One thing that you could do if you want to make these type of gains that are safer, definitely stick to options. Now, there's different ways to trade options. Mostly that we short premium, so we basically we short the option versus buying the option outright. But if you're gambling like this in the market, there's definitely a lot easier ways to make money on stocks that are well more known. So let's just say for instance, today was a big mover. Chipotle was a big mover. Let's try to zoom in here on the daily so we can zoom in. So as you know, Chipotle's been struggling for a little bit of time. They had that breakout of whatever bacteria was in their food, a lot of bad press, and they just haven't been able to recover it, haven't been able to get they have not been able to get their customers back. However, in the last week or so, they've gone from $395 up to $443. So, almost a 10% move. And you're like, well, I can't afford a stock. How can I afford to trade a stock that much? And even though it's a 10% mover, one share cost me $443. Well, what you can do is trade the options on this. Now, what you would like to do, so there's weekly options and there's monthly options, but let's just take a look at the weekly. I currently do have a short position, a short premium position. However, I am shorting puts, so that means I am bullish. So I'm selling the 440 and I bought the 435 to define the risk. So why would you say to do that is just want to show you just some of the protections that you can do while trading options. So yes, I am short. However, I have bought one option, so let's say the 33, 35. The most money I can make, so I'm defining my risk. So the most money I can make is $75 here, but the most I can lose is $428. That's not the price that I pay. That's just what the market's at right now. But I just want to show you. So instead of losing your entire account shorting something, this would then define your risk. But if you're more of a gambler, as it appears to be, if you're shorting a penny stock or buying a penny stock, you could easily make that kind of return just buying the option outright. Now, I don't normally buy options unless you think it's possibly going to move huge, which in this case today, Chipotle did move quite a lot today. It moved up $10, about 2%. And you could say 2% is not a lot of money, but in terms of options, that is quite a bit of money. So let's see where Chipotle started trading at today. Let's get the 15-minute chart here. So Chipotle started trading today it opened around 435, 436, traded at 443. So you're like, oh, that's not that big of a move. I mean, it traded $9 up. I'm used to making 100, 200% in penny stocks. But if you look at the options here, and let's say you bought where it opened, you bought some calls today, and the calls would be, if you want to buy calls, that means you want it to go up. If you bought puts, that means you want it to go down. So if you bought calls, let's say at 435, let's say it's 436. So you bought these 435 calls here. The 435 calls today went up $6. So right now it's trading at $10. So if you bought one call, so let's say right now if I bought one call, $10, it's going to cost me $1,000. But today it went up $6. So this was trading around $4 today. So for $4, $400, you always times it by 100, whatever the cost is here, because one contract equals 100 shares. So for instance, if I bought this at open at $4, it's now trading at 10. It went up $6. I made a $625 profit. So I made more than 100% on a well-known stock that's not going to go out of business tomorrow. So if you think about it, what would you do in terms of, your capital? Would you buy a penny stock that at any moment they could file for bankruptcy? And the list goes on for these like Aeropostale. They stopped trading at 15 cents. Now they only trade on Aero PQ. KBAO, XOMA, SUNQ. The list goes on and on and on. And there's a lot of traders who get trapped. So what I just want to make you aware of, there's a lot of ways to make money in the market, not just trading penny stocks for big gains. You could easily trade options for big gains. All you had to do, very simply, buy this and then hold it. It's not typically the strategy that we use here. But if there is a big mover and you're feeling like you have a little bit of money on the table that you would want to risk, then that would be something that you could do. Like I said, right now I sold a vertical put spread, so I am bullish on it. So I didn't buy the calls outright when I could have. I took the safer approach, and I think I bought it. Let's see what I bought Chipotle for earlier today. Chipotle. Okay, so I was filled for 82 cents, and then my risk was $400. So I can make a maximum 82 cents. Obviously, the further you are out, so $82 I can make, the further you are out. So let's say if you buy something for next week, or even let's say a monthly expiration, you would think it would go up. Even the monthly expirations, like if you look at the 412s today, the 412.50 went up $20. So that's $2,000 it went up. So you bought this for $1,000, it went up another $2,000. So you triple your money. So if you invested $1,000 into buying this call, just one of them, you would triple your money. That's a 200% gain. So it's definitely not safer. You could definitely sleep at night knowing that the company is not going to go bankrupt, and you're going to make the same percentage that you would have made shorting or buying the penny stock that you would, let's just say, Chipotle. And if you're even feeling like, I know that AMD is not a penny stock, but if you're looking for a lot cheaper options, so AMD is not a penny stock anymore. They used to be. AMD's been on quite the climb over the last, let's say this is just the weekly. If you look at the last year, they went from $2, now they're a $4 stock. And I think it was even lower than that a couple of years ago. Yeah, 2 years ago they're at $1.61, so they went from penny stock back up, and you're like, well, that's what I want to do, but that's not necessarily. Let's just say this is 1 out of 1,000. Most of these companies don't rebound like AMD. But if you want to trade AMD now like a penny stock, go ahead, buy the options. So you can, these are the AMD options. If you think that it's going to go up to, let's say these are expiring tomorrow. So if you think they're going to go up to $14.50 by tomorrow, or it's $14.05, you're like, oh, that's only 45 cents. These cost you $2 right now. You could buy 10 of these. If you feel like blowing money, you could buy 2 of these for $2 a piece. Will cost you $20. Your max loss is $20, and you have a bigger upside. Now, of course, this probably is not going to get to $14.50 tomorrow, but you could buy ones that are monthlies or further out. So if you want to buy these right here, let's say I want to buy the 17, like in a month, I think it's going to be $17 because maybe they have earnings or something. You could lock this in right now. Spend $100 on these. You could buy 10 of these for 11 cents, $11 a piece. The most you can lose is $100. The most you can make is unlimited. Now, like I said, that's not typically the options that we play. We play mostly high IV stocks and we short the premium. So if we're bullish on it, one good example would probably be like NVIDIA. As you can see, they've had quite a run as well, if you're familiar with the stock. But you know, I could sell this. Let's say I think by next week it's going to go up a little bit higher. I'm going to sell the 108. I don't think it's going to go below 108. And let's say we'll give a little bit more spread. So the most I can make is $79. The most I could lose is $224 per contract. I can do multiple contracts. So if you're feeling more bullish or you have a strong position about one direction or the other, basically I could buy 3 of these. I can make $228, and my risk is $672. So that's still a 30% gain, and you can do that over and over again. The thing about penny stocks is for the penny stock to go up or down, you rely on news. For trading options, you don't necessarily need a catalyst for shorting premium. You could just let the theta take over and time decay take over, and then you collect money. Or you could trade news on this, but there's a lot more ways and a lot more flexibility in trading options than there is trading penny stocks. Now, obviously, you can do it. You can make your own decision, but I say just think about it. When you're buying a company that has a Q at the end of it, know what you're buying into, and then when it goes bankrupt and you lose your entire investment, you can't get mad. If you have anything to say about the video and what we just discussed, or have any questions, comment below, like and subscribe, and I look forward to seeing you in the next video.